Welcome to day 16 of our financial wellness program, where we'll be discussing the basics of investing and how to get started with stocks and bonds. While the world of investing may seem daunting at first, it's actually quite simple once you understand the fundamentals. By the end of this video, you'll have a solid understanding of how to invest your money for long-term growth and financial security. So let's dive in. Number 1, understanding stocks and bonds. Stocks and bonds are two primary investment options, but what exactly are they? To start, a stock represents a share of ownership in a company, while a bond is essentially an IOU issued by a company or government. Investing in stocks and bonds can be an excellent way to build long-term wealth and achieve financial freedom. However, it's important to have a solid understanding of how these investments work before jumping in. In this chapter, we'll dive deeper into the world of stocks and bonds, exploring the benefits and risks of each, as well as the different types of stocks and bonds available to investors. When investing in stocks, it's important to understand that stocks can be volatile, and their value can fluctuate based on a variety of factors, including the company's financial performance, industry trends, and market conditions. Additionally, there are different types of stocks, including common stocks, preferred stocks, and penny stocks, each with its own set of risks and rewards. Understanding the basics of stock investing can help you make informed decisions when selecting stocks for your portfolio. Bonds, on the other hand, offer a more stable investment option. When you invest in a bond, you're essentially loaning money to the issuer, and in return, they pay you a fixed interest rate over a set period of time. Unlike stocks, bonds typically offer a predictable income stream, making them a popular choice for investors seeking a more stable investment option. Overall, understanding the fundamentals of stocks and bonds is key to making informed investment decisions. Whether you're a seasoned investor or just starting out, taking the time to learn about these investment options can help you build a strong and diversified investment portfolio that can help you achieve your financial goals. Number 2, setting investment goals. One of the first things you need to do is determine your investment timeline. Are you investing for the short term or the long term? This will help you decide which types of investments are best for you. Another important consideration is your risk tolerance. How much risk are you willing to take on? Some investments come with higher risks but offer the potential for higher returns, while others are more conservative and offer steadier but lower returns. Once you have determined your investment timeline and risk tolerance, you can start setting specific investment goals. These could include saving for retirement, building an emergency fund, or saving for a specific financial goal like buying a house, or paying for a specific financial goal like buying a house or paying for your child's education. It's important to make your goals as specific and measurable as possible. For example, instead of saying, I want to save more money, set a specific goal, like I want to save $10,000 for a down payment on a house in the next 2 years. Number 3. Conducting research on investments. One way to research investments is by using financial news sources such as Bloomberg, Reuters, and Yahoo Finance. These sources provide real-time market data, news, and analysis. By keeping an eye on financial news, investors can stay up to date on current events that may impact their investments. Another way to conduct research is by analyzing financial statements of a company. Investors can review a company's annual and quarterly reports, balance sheets, and income statements. These financial statements can provide valuable insights into a company's financial health, earnings, and debt. Investors can also seek advice from financial advisors who can provide guidance and expertise on investment options. Financial advisors can provide personalized investment advice based on an individual's financial goals, risk tolerance, and investment timeline. Lastly, investors can research investments by examining historical data and trends. This can help identify potential investment opportunities and forecast potential returns. Number 4, developing a diversified investment portfolio. We'll get to that in a second. I have a favor to ask of you. If you like this video so far, please subscribe to the channel. To start, it's important to understand that a diversified investment portfolio is one that includes a mix of different asset classes, such as stocks, bonds, and real estate. This approach helps to reduce risk by not putting all of your eggs in one basket. When one investment is performing poorly, another may be doing well, helping to balance out the overall performance of your portfolio. There are several ways to develop a diversified investment portfolio. One is to invest in mutual funds or exchange-traded funds, ETFs, which hold a variety of stocks or bonds. This allows you to invest in multiple companies or bonds. Without having to choose each individual investment yourself. Another strategy is to invest in different sectors or industries, such as technology, healthcare, or energy, to spread your risk across different areas of the economy. It's also important to consider the balance between risk and reward when developing a diversified investment portfolio. Generally, investments with higher potential returns also come with higher risk, while more conservative investments may have lower returns, but also lower risk. By balancing your investments across different asset classes and risk levels, you can create a portfolio that aligns with your investment goals and risk tolerance. In addition to diversifying your investments, it's important to regularly review and rebalance your portfolio. This means periodically adjusting the mix of investments in your portfolio to maintain your desired level of diversification. For example, if one asset class has been performing particularly well, it may be overrepresented in your portfolio and need to be rebalanced to bring it back in line with your overall investment strategy. Number 5, investing in stocks. One of the first things to consider when investing in stocks is the company's performance. You want to look at its financial statements, its management team, and its future outlook to assess the potential for growth and profitability. It's also important to consider the sector in which the company operates. Some sectors may be more stable and less volatile, while others may offer higher growth potential but also carry more risk. Another critical factor to consider when investing in stocks is diversification. By investing in multiple stocks across various sectors, you can spread your risk and minimize the impact of any one stock's poor performance. Investing in stocks requires a long-term approach, and it's important to have a clear investment strategy in place. You may choose to invest in individual stocks or opt for a diversified portfolio of stocks through a mutual fund or exchange-traded fund. Number 6, investing in bonds. Investing in bonds is one of the ways to diversify your investment portfolio. Bonds are fixed income securities that pay interest to the investor. In this chapter, we'll explore the world of investing in bonds and the benefits that come with it. To begin with, understanding the basics of bonds is essential. Bonds are essentially loans made by investors to the issuer of the bond, such as a government or corporation. The issuer promises to pay back the principal amount of the loan plus interest over a specified period. When investing in bonds, one must consider various factors such as the creditworthiness of the issuer, the interest rate, and the bond's maturity date. The interest rate of a bond is fixed, and it doesn't change over the bond's life. Investing in bonds comes with several benefits, such as providing a steady stream of income and acting as a hedge against stock market volatility. Bonds also tend to have a lower risk compared to stocks. However, there are also some drawbacks to investing in bonds. For instance, the returns on bonds are relatively low compared to stocks, and they may not provide long-term growth for the investor. Additionally, bonds can be affected by changes in interest rates, and inflation can also eat away at returns over time. Nonetheless, investing in bonds can be a valuable addition to your investment portfolio, especially for those seeking stability and income. By researching the different types of bonds and their issuers, you can make informed decisions about which bonds to invest in. Number 7, rebalancing your investment portfolio. One of the primary benefits of rebalancing is that it helps you manage risk. If you let your portfolio go unchecked, it could become too heavily weighted in one type of investment, leaving you vulnerable to market fluctuations. By rebalancing, you can redistribute your assets to reflect your desired level of risk and ensure that your portfolio stays on track. To rebalance your portfolio, you need to first determine your asset allocation targets. This will depend on your investment goals, risk tolerance, and time horizon. Once you have these targets in place, you can evaluate your current holdings and make adjustments as need. This may involve selling some assets and buying others to bring your portfolio back in line with your targets. It's important to note that rebalancing shouldn't be done too frequently. While it's important to keep your portfolio balanced, you don't want to incur unnecessary transaction fees or disrupt your long-term investment strategy. Instead, aim to rebalance your portfolio once or twice a year or when your asset allocation is significantly off target. Number 8, managing investment risk. One of the most significant risks of investing is market risk, which refers to the possibility of losing money due to fluctuations in the market. Another type of risk is credit risk. Credit risk is the chance of default by a bond issuer. Inflation risk, interest rate risk, and liquidity risk are other types of risks that investors need to be aware of. To manage investment risk, you can diversify your portfolio, which means investing in a variety of assets that have different levels of risk. You can also use asset allocation, which involves dividing your investments among different asset classes based on your investment goals, risk tolerance, and time horizon. Additionally, you can use stop-loss orders to limit your losses in case an investment starts to perform poorly. Number 9, final thoughts and action plan. To summarize, we've covered the basics of investing, including understanding stocks and bonds, setting investment goals, conducting research, diversifying your portfolio, and managing risk. It's important to remember that investing is a long-term game and that success requires patience and discipline. It's also essential to stay up to date with the market trends and news that can impact your investments. With that said, it's time to take action. Start by setting realistic investment goals and creating a diversified portfolio that aligns with your risk tolerance. Remember to regularly rebalance your portfolio and make adjustments as needed. As you embark on your investment journey, always keep in mind that it's a marathon, not a sprint. Stay focused, stay disciplined, and keep learning. If you're enjoying these daily lessons and want to continue learning, be sure to subscribe to our channel so you never miss an update.